Welcome to the Financial Advisor Success Podcast, where you go behind the scenes with financial planner, speaker, and consultant Michael Kitces to hear stories of how leading financial advisors navigated the inevitable challenges that arise on the path to success, and get insight from leading industry consultants about how to break through to the next level in your advisory business. And now here's your host, Michael Kitces.
Welcome, everyone. Welcome to the 475th episode of the Financial Advisor Success Podcast. My guest on today's podcast is Erik Brenner. Erik is the CEO of Hilltop Wealth and Tax Solutions, an RIA based in Mishawaka, Indiana, that oversees approximately $600 million in assets under management for 830 client households. What's unique about Erik, though, is how he has doubled his AUM in the past 3 years, in part by offering a deeper level of tax-related services, including preparing client tax returns through an associated business, and by working with an external firm for expertise on more complicated client tax situations. In this episode, we talk in depth about how Erik decided to partner with a CPA, creating a separate tax business alongside his wealth management firm, with both under one brand umbrella. How Erik takes a three-pronged approach to tax planning by having advisors leverage tools such as Hilltop and Income Lab on the wealth management side, using the CPAs from the tax business to review proposed planning strategies, and working with an outsourced provider for expertise on more complex tax planning issues, and how Erik offers tax return preparation not as a loss leader for his wealth planning services, but rather as a profitable line of business in its own right. We also talk about how Erik's firm brings in almost half of its new clients through in-person dinner seminars where the team demonstrates its expertise in the key issues facing their ideal clients, such as reducing their tax bill in retirement, how Erik uses a service that sends sufficient mailings to ensure a full room at each seminar, saving his firm the time it would take to market these events as well, and how Erik generates new client revenue from these events that exceeds the cost of holding them in the client's first year alone. And be certain to listen to the end, where Erik shares how he takes a two-pronged approach to generating online reviews using both Google reviews, which helps with the firm's search engine optimization, and Amplify reviews, which appear on the firm's website. How Erik invites all clients to leave reviews, then uses the firm's CRM to track responses to ensure clients aren't asked to do so after they've already left one, and how Erik has ultimately found success not only by offering a deeper level of tax planning for his clients, but also by developing his leadership skills to manage a growing firm and help his team grow their careers as well. And so, with that introduction, I hope you enjoy this episode of the Financial Advisor Success Podcast with Erik Brenner. Welcome, Erik Brenner, to the Financial Advisor Success Podcast.
And Michael, thanks for having me. I really look forward to sharing the information. It's great to be here.
I'm really glad you were able to join us today, and I'm excited to get to talk a little deeper about this ongoing industry push of getting deeper and deeper in helping clients with their taxes. And it's a really interesting evolution to me because for a lot of years, there was this trend of tax firms coming into wealth management. It was like the big CPA firms that have all these existing accounting clients that they can cross-sell to wealth management, even smaller CPA firms that could like sign on with a TAMP that specialize in CPAs, or one of the broker dealers like HD Vest and First Global, which are now all rolled up into Advantax. We're reaching out to CPAs and showing them how to expand into in the brokerage and wealth management side of the business. And like the AICPA even has its own version of the CFP financial planning designation that they call the PFS. But I find in the past few years, the pendulum seems to be swinging in the other direction now. So it's not tax firms coming into wealth management, it's wealth management firms going into tax. So we're going deeper in tax planning with all the new software tools like Hilltop and FP Alpha. Our Kitces research study last year found almost 1 in 6 independent firms are now doing tax preparation in-house for at least some of their clients, either building out with staff or even acquiring a CPA firm to bring it in-house. And I know you have been down a similar path in recent years with your firm as you've gone deeper and deeper into tax offerings with clients as a way to grow the advisory business. So I'm really excited today to get to nerd out a little on lessons learned and what it really takes to build a tax practice alongside an advisory firm.
Yeah, I'm really happy to share kind of our journey and, how we've decided to, evolve and continue to evolve our tax planning and preparation business.
So I think to kick off, just to help us get oriented, Tell us, Eric, about the advisory firm itself as it exists today.
Yeah, sure. So we are an independent registered investment advisory firm. We have four main offices, one in Indiana, one up in Detroit, Michigan, one in Florida, and another one, actually two in Indiana. And we currently are north of 600 million in assets under management. We have on our advisor team, we have 6 advisors, with one of them actually retiring next year.
Oh, very cool.
And then we have a team of 9 folks in staff, a couple part timers on the wealth side, and then on the tax side we have 7, and I have a partner on the tax side. So the tax side of the business, we not only do individual returns, estate returns, trusts, and so forth. We also do a fair amount of ongoing bookkeeping
Okay.
for small businesses, payroll processing, and we certainly can dig into more as to our thoughts and why we're doing that. So it's more than just tax preparation.
And can I ask revenue overall for the firm?
Yeah, so on the wealth side, we're just shy of 5.2 million. We'll
Okay.
end up about 5.2 million. And then the tax side, over 12 months, about 825,000.
And so about six million combined, roughly 85% wealth, 15% tax.
Correct.
And how many clients is it?
So total clients so we're talking wealth clients is about 830. And
Okay.
then on the tax side, we have about 60 ongoing business relationships. And then, we do obviously do a lot of the tax returns for our wealth clients. And then we still, at this point, do some tax returns for non-wealth clients. Although one of the goals that we have is that that will not be the case, at some point in the future. Once we get the tax business to a sustainable business in itself, which we can talk more about. But, I really started out this journey of, I didn't want to be in a loss leader. Like a lot of firms that I talk to, they say, "Oh yeah, we do tax. It's a loss leader. We don't make any money." I really wanted it to be sustainable business on its own.
Okay. It's and do you know, I mean, even roughly, like how many returns do you actually sign and go through on the tax
Yeah,
side?
so we just had an acquisition. So on the tax side, we've actually done 2 acquisitions. We just had one a
Okay.
few months ago, so we'll go in. But next year we'll be in the range of 700 to 800 returns.
Okay. Oh, and thus also why you've got both client returns and non-client returns, because you bought a business of people doing returns that were not your clients. So it takes some, even if you're going to consolidate that to be client focused, it takes time to do that transition. You don't
It
want to,
takes time.
you don't
Yep.
want to blow up the business.
Yeah, and our strategic plan was such that, as I said, we wanted it to be a sustainable business, right, on its own versus this loss leader. And so, by having the revenue on the tax side of it, certainly also look at the opportunity of cross marketing, but we just feel like it was the right steps in the way we wanted to go about it.
And so, I mean, we all have a range of clients we work with from small to big, but if I napkin math here, I mean 600 million of AUM, 830 uh wealth clients that you're working with. So you are like your firm is squarely in the mass affluent kind of space. That's like an average account household of 700,000 or so. So you like, is that fair? Like your clients are the half million to $1 million folks is your sweet spot.
Yeah, I mean, that is fair. Our average has gone up over the last few
Yep.
years because we've been focused more on the million plus.
Okay.
And our average actually new client this year is a little over 1.3 million
Okay.
average.
So you've been
Um,
trying to move a little bit up market over time.
exactly.
Okay.
We have a fair amount of those that are kids. Those
Yep.
clients have been clients a long time. We have a very tenured advisor team, so they've got clients that's been with them for 25 years. So it is moving up.
It is striking to me though that just when you talk about these numbers for the business, uh 7 on the tax side supporting 800,000 of revenue, 15 on the advisory side, supporting over 5 million of revenue. It's like the advisory side is 2x the team and 5x the revenue, which I guess just gets to the joys and challenges that we'll probably talk about of like how to run tax businesses so that they're not loss leaders to wealth management.
Yeah, it really is. And, although a couple of those would be part-time, right, based on tax or they're
Sure.
part-time workers, but I thought it's a financial business. It's going to run similar. Well, that's really not the case. Um, and certainly knew that, the margins aren't there that we have on the wealth side and so forth. But they are definitely two distinct businesses.
So let's dive in a little bit further there. I guess to start, I'd love to understand a little bit more about how the tax side of the offering actually works. Right? Like what do you do? Who do you do it for? How do you deliver it? What do you charge? Like tell us more about the tax solutions here under the umbrella.
Yeah. So I think it might help a little bit of the journey and kind of then getting to, how we work it within our models. So
Okay.
like many advisors, I worked at networking with CPAs, professionals, attorneys, and so forth. And we just never really got traction. It was always a one-way street. And we never really got traction with receiving referrals, getting CPAs licensed, those kinds of things. And then when I go to conferences, they would talk about it. And then they'd ask people in the room, how many people have had success, of 5 or more relationships, 3 or more, or 1. Very few people ever really stood out. And I thought to myself, there's got to be a trend here. I mean, if I'm doing other marketing and I'm just throwing money at marketing, there's a point in time where I have to consider this ain't working.
Yep.
And so that was part of it. And then the second piece is really where we wanted to take the vision on being a really true comprehensive advisor. And we wanted to really do comprehensive tax work planning. So it was all led around the planning part. And we feel more and more people we are seeing want that tax planning piece. So with that, we said, well, if we can't find somebody, we're going to build it. So what I did is I started looking for somebody that wanted to be in the tax business, had some experience, wanted to own a firm, and partnered with them and said, look, I have an opportunity. I want to establish this business. You want to establish a firm. I will give you some ownership day one. I'll provide the funding. Let's get this thing up and running. We have some built-in client base. And, we want to make sure we're integrating the tax work as well, the tax planning. That's really the key. If I could have not done it and not done tax preparation, that would have been fine. But our firm wasn't of size to have CPAs on staff that are not doing the tax or, not producing that, right? Non-revenue, so to speak. So the journey then went down and, we started building this, and we actually have a separate entity for the tax, but market under one name. So we market under our brand name and we market under one name. And then we really start.
But I just want to be clear, but it's two separate entities. It's two separate entities that are underlying. So I guess separate engagement agreements. The tax return engagement letter is to a different entity than the advisory agreement letter when you get down to the paperwork contracting level.
That is correct. Yep. And then we were doing this tax planning, and we've gotten into more even tax planning and tax mitigation work. And so we were doing that on the advisory side, and we wanted to have this backup with the tax. And so we also saw that we wanted to have an offering. So how we set it up was clients could utilize the tax, and certain level of clients, certain assets, what we call kind of category of client, they could certainly pay to get their taxes done, and they get a discount from someone walking in the door. They're going to get a discount. But our elite clients, our $1 million plus, our $2 million plus clients, we wanted to offer the opportunity to have tax, their personal tax, done inside the agreement. So,
Done inside the advisory agreement.
Correct. So,
Okay.
so we, because a lot of clients were saying, why can't you just do this? And quite frankly, we have a lot of more complex tax returns, but we also work with a lot of clients is they need tax planning. They have required minimum distribution issues. They have other issues, IRMA and so forth, but they don't really have a tremendously complex tax return, right? As far as
Yeah.
preparation, it's more the planning. So we offer that with clients and say, look, you are an elite client with us. This is part of our service. And I didn't want to make it just a loss leader. Tax charges wealth, a discounted fee. So every client that tax does a wealth
Oh,
client tax
interesting.
return, we charge it. And
And
so
so
that keeps the revenue.
it's a debit to the expenses of the wealth business to recognize the cost that you're covering down on, and then it shows up as revenue on the tax side.
That's correct.
Okay.
And so what's happened is we've seen where clients like that, especially as they get into life and into retirement, often simplification. They really like the simplification part. And we're able to do the planning as needed, and we're able to do the tax, and we're not asking tax to do it for nothing, right? So they support each other, and we just looked at it and said, look, it's worth a tax return that really is minimal compared to the AUM, right? That we and how we get compensated for the other work we do. That
Can
this
I
is a value add.
can I ask? I mean, what are you charging as the crossover fee, as it were?
Typically, it'll range 400 up to 8, 900, 1,000, somewhere in that range.
Okay.
Thousand's going to be more. We also limit. So if somebody's got, a bunch of partnerships and real estate and Schedule Cs, the clients know that they're not going to get all of that wrapped in. We're
Okay.
talking your personal return. So in
Sure.
those cases where they've got more complex, we give them a credit towards it, but we're not paying for the whole boat.
Okay.
Um,
And then what's the advisory fee? Are you the like the stereotypical 1% on a million, or is your fee schedule a little bit different?
yeah, so on a million would be at 1.1. So
Okay.
we have a graded, you have more, right? You have more, obviously it goes down. And
Yep.
we do mainly AUM, and don't really separate the planning. I mean, this is just what we do. And
Yeah.
so that's how we share with clients is, look, we're doing this comprehensive, approach, and
Yeah.
you're going to get all of this. And, our differentiator, one of them is we're also going to really do tax planning.
Yep.
That quite frankly, I think that those two words, tax planning, together get thrown around a lot.
Yep.
And it really is just kind of basic tax planning. And a lot of times, obviously, due to limitations of advisors and what they can talk about.
So I can see how it comes together if we want to benchmark a median fee of 1% on a million, but most of us aren't doing tax preparation house. Your 1.1, it's a little bit more premium, but you have a more premium service where you actually do the tax return in-house and cover it if you have at least $1 million. The extra 0.1% on a million is $1,000 of fees, which covers the tax return that you're then paying internally. I mean, just like
Yeah.
the math lines up very, very cleanly. You've effectively bundled it into the AUM fee, but you actually did set the AUM fee at a level that will cover the bundling costs.
Yes, exactly.
So did you actually have to change the fee when you started doing tax, or were you always 1.1 and this was a reinvestment tactic for you?
No, we have right now two kind of schedules, that we have our IA agreements and so forth. So we had a base of clients. We broke out of a independent broker dealer in 2018. And
Okay.
so when we did that, we had, clients at a certain level of fee, and we were actually able to establish them, didn't have the tax business then, and we were able to establish a fee schedule with them. And oftentimes we were able to drop it because, we were saving money, not being affiliated,
Oh, you
a lot of
you
money.
you cleared so much eliminating the BD cost layer that you could drop fees slightly for clients and actually still net equal or better as an RAA.
Yeah, exactly. Because the 1% that as you brought up and talked about, well, to get to 1% in an environment where you have the haircut, you sometimes have to charge 1.25, 1.25 to get to the one,
Mm-hmm.
just because of the haircut.
Yep.
So we were able to often get, in most cases, change fees for those clients. So then we rolled out, and then since then we also have any new clients coming on. Here's the schedule. So they're pretty close, regardless, both of them. And we keep an eye on benchmarking studies and so forth, kind of where we're at, and what's it going to take to be competitive.
I mean, do clients, do prospects ever bring it up? I mean, I know we in the industry love to take shots at each other's fee schedules and fee structures, but I mean, you got north of 800 clients now. So do clients bring up or raise any concerns of, Eric, why 1.1? The other advisor up the street only charges one.
No,
Does it come up?
No, it really, once we show them our model, which is tax, comprehensive planning, even estate planning. Once we show them what we're delivering, it the value there, it just doesn't come up. And oftentimes we've even seen it still is lower. So than another firm. So we lead a lot with tax and tax planning, just because those are the folks that we're running across, and they're going to have these issues, or have these issues beyond, do I have enough? Am I saving enough? Most of the folks we work with, they're not, okay, how much do I need to save so in 15 years I can retire? We do work with some young professionals, doctors and so forth. We need to do that. But a lot of them are, okay, now I know or realize or have a fear that taxes is going to could be, and probably will be, my biggest expense in retirement. What do I do?
So how do the economics work on the tax business side of things? I guess I'm trying to visualize it. It sounds like you started the tax business with a partner. The wealth business was one you created yourself. So you've got different cap tables, as it were. Like you've got different ownership of the separate entities. So I'm presuming that means they really have to each run their own P&L. That's also why you cross over the fees from the wealth side to the tax side, because you've got a tax partner who needs to participate in the appropriate profitability on the tax side of the business.
Yeah, that's exactly right. So we run separate P&Ls. As we said, they're separate businesses, and they certainly have our wealth clients as priority when it comes to
Yep.
tax, but they have the other businesses as well, and the other tax and businesses they work with, and run that business as if they were on their own, but we have the integration.
Okay. Except it sounds like the goal over time is that eventually they can shed other clients outside of the wealth management firms, because you think over time you can fill them up and keep them busy with just wealth clients as you grow and roll this out for a growing client base. Is that am I following that correctly in terms of the longer term plan?
Yeah, you are. Individuals for sure. Businesses, we see still growing that business. So,
Okay.
we have a business, and one of them that we acquired had ongoing revenue business clients.
Okay.
So it was established similar to our business. We're going to do this and payroll, and, your books and your financials, and here's what it's going to be for the year, broken down monthly. And I've noticed that those business, tax, accounting, CPA businesses actually are starting to see our businesses, and they're starting to put that in place. So we like that business there, because obviously it's ongoing. You can plan for it, and it's also can be attractive to the business owner. They know, okay, I'm going to pay $800 a month or whatever it is for these services, versus, I don't know, this month over next month. So we want to grow that business part of it. And then the other part of it is we see, that some of that business could lead over to the wealth side as well.
Oh, because the tax businesses, small business accounting clients, can eventually be wealth management prospects. who already know and trust the company and the brand because you've been giving them lovely payroll and bookkeeping services for some number of years.
That's correct. And we do think about bringing those clients over, but I often have run across firms that's their number one goal is I'm going to get an accounting practice, I buy at a lower multiple, and I'm going to bring clients over. And I've had many conversations where that is not as easy as it sounds for whatever reason, and we're still working on making that what I would
Okay.
call successful. We looked at it more as a service advice deliverable for the wealth clients and get leverage there, right? And bringing in newer clients, newer money, because we have the service, which now this has been, we're in our fifth year of this business. And it's gone pretty well. We've got people that we know have come over, or at least what we brought to the table. They said, "Yeah, I need this," and so that's worked. So we certainly want both of them going back and forth, but we approach it a little different, I think, than I've heard of is buy the tax and accounting and then get everybody over to the wealth side.
Thus, again, getting back to because you actually want to run the tax business as an economically viable tax business, not just a, I guess, loss leader or lead gen funnel.
Correct.
So can I ask, like, what kind of margins do you shoot for? I mean, I don't know if you have, a goal margin for the tax business, a goal margin for the wealth business, and just think of one as a lower margin than the other. Like what do you shoot for? I guess for folks who are listening, what is a realistic expectation of what kind of profitability can you support from a tax business as contrasted with the wealth business?
Yeah, I mean, the tax business certainly is lower margin. I mean, it's obvious based on revenue. There are times within the tax business that obviously you do a tax return for someone and you don't see them for a year, so you're not servicing the client, right? There's not other issues
Yep.
as it relates to that. But we shoot for the industry standards. The tax business has been at about break even up to this point, which is fine with us because we've had some acquisitions, and it's maintaining itself. And like I said, we want it to be a profitable business, but it's also providing us really, a big piece of, our ultimate vision in being comprehensive in nature. So
What's what's the industry benchmarks for it then that you hope to get to? I mean, is that a
yeah,
10% margin business as it grows? Is that a 20?
yeah. I mean, I'd say in the 15 to 20, you're kind of in the a top percentile on the tax side.
That's a good
Because
percentile in the
it's
tax side to be at 15 to 20.
yeah,
Okay. It's just a good expectations re-anchoring maybe uh for some of us that are used to, 20 something, low 30s even sometimes for wealth businesses.
exactly. Yeah, and I knew that going in, and um, again, just knowing that, okay, it wasn't just about, this business, we want profitability and all of that for sure, but, there was a bigger picture, right? There was a bigger goal in mind, and there still is a bigger goal in mind, kind of moving forward. Now we've got some synergies of, a bit of cross, employee, synergies certainly on, as I mentioned, the planning side, a lot of synergy there. And, we've got tax software that we can do planning with. So, we can do verifications, and we tell folks all the time, we don't hide behind it, right? Our advice, we don't hide behind tax. Like we don't prepare a high level projection and say, okay, now you got to go see your CPA.
Like we are your CPA.
Correct.
We saw ourselves before providing you this analysis.
That is correct.
So so I'd love to understand a little bit more there of just how you weave this in, I guess now and sort of the vision for the future. I think you said earlier it's like automatically covered for elite clients that want to use the service, and you pay from one entity to the other to keep the P&Ls true. Uh, like, what's the long term vision for this? Is it a elite clients, you pay, everybody else they pay, but you want to do it for everyone? Is the goal that this is specifically like an elite client's service and it's part of a like segmented service tier? Like, how do you see this playing out over time?
Yeah, how we see it is certainly we see it as number one, the elite client service, and continuing that and continuing, what we're doing there, and truly, tax planning every year and offering it within our advice model. The other clients, we also see offering that as a benefit still. I don't think we see those other clients, if they want to use us, they're not an elite client, you still have the opportunity to use us, because I think a lot of people, client wise, we don't want to leave them hanging on the tax. They
Right.
don't get the extensive tax planning. It's more about, here's the preparation, similar to what they would do, at another firm. But there's also, in the industry, there's a lot of smaller firms closing shop. There's people, retiring. So we don't want to leave them hanging out there as a client. So we really do see them as a client. Eventually, we may have to think about a bit more segmentation. But if we eventually shut off the person walking in the door for a tax return, then I think we can, it can be manageable. The other thing that's going to increase more and more is the intenseness of the planning part. The preparation is one thing, obviously, numbers in the box, but the planning part. So there's going to be more and more of that as the firm grows and those types of clients grow.
So help us understand more of what you're doing then on the tax planning side. I'm kind of curious, like, what are you doing? Which clients are you doing it for? Who actually does it in the firm?
Yeah, so we start with our elite clients. So our elite clients we start with, and we ask for tax returns. It's amazing, Michael. We do a fair amount of seminars, and when I bring it up, like, how many people's advisor has ever asked for their tax return? And it's very few hands.
Well, you're
Typically,
talking to consumers.
the consumer. So the point is that we actually ask, right? So clients, they know they bring their tax return. So the
Mhm.
planning starts with a tax return, and we use Plan for our tax planning. The wealth advisor starts with that. So they load up a Plan. They take a look at, okay, what happened last year, but then really scenario planning for this year. So they start working through the plan of what's going to change, this going to change, that's going to change, right? And working through those scenarios, and could be creating multiple scenarios. If they want to do a Roth conversion, if they want to do a Roth conversion with a mitigation. So we do a lot of mitigation, oil, gas, solar, things like this, more complex situations. So the wealth advisor gets a kind of high level on the plan, on the tax plan. And
And I'm sorry, go ahead. Go ahead.
yep. And once that gets established and we kind of know a direction, then we bring in the tax side, and we always say we're gonna walk through this and get a pretty good plan and think we know where we're going, and then we're going to bring in the tax side. They're going to take a look at it, run it through our super duper software, right? Make sure everything's in a touch. Do you need to change withholdings? Do you need, is there anything in the background? And so they will do a double check. They will not rely on Plan fully. So it runs through that. And then we come back with, okay, this is the plan that we're at. We need to do this, do this, do this, right, prior to year end. So that cycles, and it does it the next time. So we have those clients that are the elite clients. And granted, some of them doesn't change a lot year to year. Some of them, situations change quite a bit. So we spend, starting September, we spend a fair amount of time in that area with those clients.
So starting in September, so kind of I guess Q4, last 4 months of the year, you're trying to queue up whole list of plans with elite clients to do sort of an end of year planning and projections.
And then,
And
then on top of that, that's an important point, is we actually have a partnership with a firm that's a CPA firm that does nothing but high-end tax planning work. And you
Okay.
may say, well, Eric, why do you have that? You have a CPA. Well, yes, we do. But this firm does nothing but high-end tax work, right? Mitigation, sales of business, right? High income earners. And so we will work with them on cases. So we have the advisor looking at it. We have them looking at the higher end tax, and we also have our accounting side, right? Our tax and accounting business. So we have a collective kind of group really looking at a client situation and determining what might be best.
So, so many questions here. So the working with an external firm for the more, as you framed it, high-end tax planning work. So can I ask who are you working with there?
Yeah, so it's called the Walters Institute.
Okay.
Heath Walters is great, him and his team, and they've done it for a long time. And they work with firms, they work with individuals, high income, high net worth individuals. And that, again, that's all they do. So they don't do any prep. So they have time to spend time in the tax code and working on
Oh, so
the
so
situation.
it's planning only.
Planning only. Right.
And so this doesn't displace the tax preparers internally. This is like an expert resources thing for you to just like to have someone to tap when you get into very complex client scenarios where it just helps to have more expertise at the table.
Exactly. And we look at it as, like many of the different services that are available, it'd be very costly to have that ramp them up, have somebody experienced like they do on the team. So they're part of the team, and they'll even meet with clients along with the advisor as the team. And we tell the clients that. So the clients that we utilize their service, they know, right? We have, an expert we resource in addition to our tax team. And it's been very well received in the sense that I really appreciate you have a team. It's not just I'm talking to my advisor.
So in that vein, like who pays for what? Like how does Walters get paid, and who pays them, and what do they get paid?
Yeah. So what we have arrangement, they have different arrangements, but we have
Okay.
a retainer we pay them. And within the retainer, we get a couple things. One is we get ongoing support and casework weekly. So we can do casework with them on the higher end cases, right? We
Okay.
dig into the case weekly. So that's part of it. They also have ongoing education where we jump on Zooms and they talk about other strategies, all kind of captive insurance and, other strategies that quite frankly, we don't run across all the time. So
Okay.
just because it's, specific case. And so we have not passed that along to the client. Um, we may look at that differently, but right
Okay.
now it's working because, and it's also teaching the advisor and teaching the tax and accounting side. We could get to a point where we may need that in-house, but right now it's working and it's cost effective. That
Can
we have found in dealing with those types of situations. So we're pretty particular on who we're using, what client we're going to take through this external planning.
because you get like a certain number of hours per week or month for doing these consults, so you have to decide which clients are appropriate to utilize the resource of this retainer agreement.
That's correct. Yeah, that's
And
exactly it.
and can I ask, like, how much do you spend like on this relationship to set up this relationship?
I think it's about 2,500 a month.
Okay, so I mean that is way less expensive than hiring a super nerdy, highly advanced, mega experienced like CPA advanced tax expert. I mean, you're talking 2,500 a month is 30 grand a year instead of spending a lot of six figures on a very expensive, super experienced person that you may not be able to keep totally busy anyways.
Yes, way less with chances are a lot more experience.
Right, right,
and
right.
and we're really able to say we get a situation where even though we're experienced advisors and someone's selling a business or someone's doing something that could use some of that advanced planning, that we now have a resource for it. So
And
all in all, it's been a good relationship.
I guess I can see in that vein, if they're charging you a flat retainer for sort of a block of units and time available, it's kind of awkward and hard to pass it through and bill it to the client. Anyways, at some point, it's just, look, you could have a staff member and then you would eat the whole thing because it's just part of the wealth services. You could, buy fancy software, you would absorb the cost. Instead, you've got an expert resource in a people and team, and it's just a cost of doing business, like a resource to be able to deliver good tax advice to clients.
Yeah, that's exactly right. And I know they work with some individual clients as well. And, often that when they get an individual client that they want them to work up a tax plan, that alone could be 10, 15,000, for that client.
Mhm.
We would have the choice that we could have the client pay them directly and say
Okay.
we're working with them.
So there's probably some threshold where it's so messy they're going to blow out your hours for the next 3 months combined. Like we just need to kind of have a separate agreement and have the client pay.
It
Uh,
really could. The other thing that we've appreciated is, we have a set time every week. It's just almost like having really someone down the
yeah,
hallway that has this just expertise that, it's the business is so difficult and complex now. You
yeah,
don't know it all. So you just have this expertise. And so they've been really good with just
I
being
love it.
able to do that and talk to, clients as well. And they know that. And I just can't tell you the amount of praises that clients have said to us. And we ultimately look at that and say, we'll get more assets. We've had a couple clients, one that's a CEO of a business that's taken a company public. He's like, you're getting all the money, because he knows, we have these capabilities. And so we feel like the AUM that will come from it, also, will certainly more than pay for what we're paying for that resource.
Uh, it's a fascinating model to me. So for folks who are listening, like if you're curious and in checking this out, so we'll have a link out to the Walters Institute in the show notes. So if you go to kitsis.com/475 for this episode 475, just scroll down a little bit to the show notes section. We'll have a link out for others who may be curious in exploring this as well. So Erik, so now I'm kind of wrapping my head around the layers here. So it feels like there's sort of three tiers of services, of stuff that you do. There's the planning work. Well, I guess so. There's the in-house tax preparation. You cover it for elite clients. Others can pay directly if they wish. Uh, there's the tax planning, which is driven by the advisors using Holista Plan and maybe checking in with the tax side of the firm to gut check or validate the numbers. That's included as part of the advisory fee. And then there's advanced planning scenarios, which is part of the advisory fee because it's good relationship for high value clients. You may even win more business, but you spend $2,500 a month on Walters Institute to have this additional resource available to make sure that you really can bring the right expertise on complex client scenarios for tax planning.
Yeah, that's exactly right.
Okay. So how does this, how has this shown up for the business? I mean, I think you said you're 5 years into this now. So I don't know, is it working? I don't even know how you evaluate what working means, but you had this vision of bringing tax in. Is it working?
Yeah, we think it is for a couple reasons. We just finished a client survey. We hadn't done one in a few years. And on the client survey, there was a lot of appreciation. There was some questions around the comprehensive and so forth. So we're getting feedback from clients. We also get feedback from clients on the fact verbally with advisors. I really appreciate this. So that's another piece of it. The other piece of it is we continue to kind of pinch ourselves as advisors as we're bringing on new clients. It's becoming pretty rare that we even talk about their portfolio because we're really preparing, we're going to prepare some preliminary information. It certainly could be on projection of assets and future required minimum distributions. We could prepare a snapshot on a tax plan. We take clients to a second meeting. So we basically gather some information and take them to a second meeting. And it's amazing that they'll transfer $2 million and they didn't ask us, so how do you manage money? That's becoming more and more common, quite frankly. And so we've pinched ourselves over the last couple of years going, this client just came on and they never asked about how we manage money. Back in 2022, we were at 317 million and now we're over 600 million. So, the markets have been good, but we've also doubled. So I think what I said is that we weren't just focused on the accounting tax side to bring those clients over. We wanted to enhance our offering and strengthen our offering so that when new clients come to us, and current clients, we could strengthen the offering that here's what we offer. So those pieces together, I think, really says to us, the clients we're looking for and the ones that we mesh up with, this is what they're looking for.
And so then tell us about how growth works. Like, where are all these clients coming from to find out that you have an integrated wealth and tax offering? What's the marketing or business development process for the firm?
Yeah, so this is my 32nd year as an advisor, and all of those years on and off, I had done seminars. And they kind of worked for a while and then you go away and they work for a while. So we got back into seminars after COVID and doing dinner seminars. And so really a lot of the clients have come through that resource. A lot of them, not quite all of them, but about 40, this year, about 44% of the new clients came from there.
And how many new clients come in a year for you? I don't know
50,
what the normal number is for you.
50 to 55. Yep.
Okay.
So, and this year we had 60 million of new money, as of to date, 60 million of new money relationship. That's not new money from new people or existing clients. That's just new relationships.
Okay.
So part of it, I think, with the seminars is the advice in our advice model, and people are attracted when they come. And we have very similar numbers that, so many show up, so many book an appointment and so forth. But because we're not a product based at all, we're advice based, registered investment advisor, they often go and it ends up being a product or some sort of product. And so they're open to that. And so through that education and connecting with those people, that's where a piece of it comes.
So can you share more about what the seminar content is? I mean, what's the session? What do you deliver? How do you convert them at the end? Like, what is the actual seminar event?
Yeah, so the seminar event is, the titles have been differently. A tax bomb is coming, retirement and things that you may not be aware of, different titles. We take them through required minimum distributions. So one of the things that got me thinking about this years ago, Michael, was with the tax was I had a client that had very large IRAs, and their required distributions were going to be large. And we're trying to talk about it well in advance of required minimum age. And so this is before we had the tax business, I worked up a plan, and I said, okay, now we need to go see the CPA. And I knew the CPA. So he goes to see the CPA, which I referred him to, by the way, to get his taxes done. And the CPA said, no, that's not a good idea. And so I ended up calling him, and I said, so what'd you base that on? He goes, yeah, it's just not a good idea. I said, did you ask him how much qualified assets he has? He goes, no, I never did that. And when I told him the amount in the millions and his projected required distributions, I said, now how do you think about it? So that was kind of a moment that I said, we've tried to connect with these folks, And, they're doing their work, they're busy in their work. We need the true planning piece, and then we need to connect the tax side. And so in the seminar, we talk a lot about required distributions. I think it's going to be something in the next decade or so. People are going to have these $250,000 plus a year force outs that don't need the money. And it's a tax bomb waiting to happen, especially with Secure Act. And so we talk about that. We talk a bit about estate planning. And then we actually show a couple cases, change the names, on Roth conversion. What's that mean? Tax mitigation and tax planning. What are the differences? What's that mean? And then in the end, we just offer up the opportunity to sit down. No cost, no obligation. I'm interviewing you as well as you're interviewing us. We don't know if we can help you. And if we can't help you, we'll certainly tell you that. But if you think you want to take a second shot, if you're already working with someone, or if you want to take a shot and you're getting close to retirement, and that's kind of the wrap up. And it's worked. We typically get 40 to 50% of the households, in the low 40s. And then we work through our process. Some of them don't qualify, but ultimately the numbers in 32 years hasn't changed a whole lot. So we don't really convert, I don't think, that much more, but they're also coming in with that, with knowing what we do and how we paint that picture.
And how many people are typically in the room for a seminar?
Typically 20 to 25, maybe 30.
Okay.
Yep.
And then 40% convert to what? To schedule a meeting?
Yes.
And then what percentage of those actually end up becoming clients?
Yeah. So typically what will happen, we'll have 40% to a meeting. And then those that show up, about 70% of those will schedule another meeting. Because we don't close in the first meeting. We say we're going to gather information.
Right.
And we've just found for us that works best for us. And then if it makes sense, we move on to the next meeting. And so you've got about 70% that will go to the next meeting. And then if they're at the next meeting, it's more than 50%. We're at about 55 to 58% right now. Of those 70 that show up for the second meeting, more than half. So, and by that time, we know they're a fit because we have their information. We won't meet with someone. We don't ask for extreme detail, but we won't meet with someone if they don't give us at least what we're asking for. We just don't. And so by the time they come back, we know their information. We've loaded up and showed them their numbers. One of the things I've learned is that ultimately they can see a seminar and you do but when you get to your number, that really then drives home. So we show them some numbers, and depending on the situation, we may show them some projection in Income Lab. And, here's your projection of your required distributions. We may show them a Holista plan. We may show them some other things, and then ultimately drives them to levels of concern. Maybe I need to bring this together.
Can you explain where you use Holista Plan versus Income Lab?
Sure.
What are you actually doing with each?
Yeah. So Income Lab we use in the sense of all about someone has enough. What's your lifetime tax? Or can you do other things, right? Can you do Roth conversions? Can you lower your lifetime tax?
Okay.
That's what Income Lab is. And we found that to be visually really good. Does it make sense to do this?
Okay.
We get questions all the time about Roth conversions. Does it make sense? And we certainly in the seminar talk a lot about it and showing examples. Holista plan's more of the direct scenario planning. So we may throw in there Holista plan. Here's a projection. Here's where you're projected to be, but here's an example. If we ended up working together, if we did this, if we did that, this would change your overall tax nut by this. So Holista Plan has a really nice tax report that is easy, pulls up, and it's amazing how much value that tax report can provide to not only clients, but also prospects.
So Holista Plan is your like last year's tax return scenario planning for this year and where they are. Income Lab is the like super long term over your lifetime. What are your taxes cumulatively going to be? And then how can we bend the tax curve and bring that down with Roth conversions, minimize IRMA, manage RMDs, like all the different things that we can model over multiple decades.
Yeah, that's exactly right. And then if it's a basis planning as well, we'll bring in Money Guide Pro. So if we need that comprehensive planning, right, the more pieces, we certainly use that in conjunction with Income Lab. We just haven't found an Income Lab seems to be it, where it's very visually easy. It lays it out. You can do side-by-side scenarios, gives them the actual raw numbers. So we use a combination of those to get us to what the advice is going to be.
So if I take a step back for the seminar, if I'm thinking about numbers right, like 25 people in the room, about 20 to 25 in the room, 40% convert to a meeting. So like 8 to 10 convert to a meeting. It's a 2-meeting process. 70% fall through with the occasional low show. So I'm assuming like 5 to 7 show up for second meeting, and a little more than half, so like 3 or 4 close. So if you do a seminar, 20 to 30 people come, 3 or 4 clients at the end of the funnel. Am I thinking about that right?
Yeah, you're thinking about that right. I would say one of them might be not now, but maybe in 6 months, right? It's activity. We kind of think about the seminar, if you can get 4 to 5 people interested and scheduled per session. That's, if we can walk away, if we do 2 seminars or 3, 10 to 15 appointments scheduled.
Yep.
And then the numbers just work itself through.
And so how many of these seminars do you do in a year?
We do in the neighborhood of 15 to 20.
Wow, okay.
And they would be that, one campaign, but you might have 3 nights or 2 nights.
And so I'm sorry. So you do them, they're evening events. Are they, is this like local library, community college, restaurants? Like what's your seminar setup?
Restaurant. So we've tried, the restaurant, and often it is the good old male. It comes back to what I did 32 years ago.
Mm-hmm.
You can target it. You have a campaign. We've tried to do social media some. It can waver a little bit on the quality that shows up. And the math, we just work it backwards. And so we do those campaign and either 2 or 3 nights, depending on the volume and what we want to do. And they've worked out. Michael, I always tell the team, like, okay, it's working this year. We'll see, maybe something. But, we've had a lot of change. Secure Acts and, tax laws and, over the last 5 years. So right now there's an interest there. And, it's worked.
And particular restaurant of choice?
Yeah, we use Steakhouse, nice restaurants, not the highest end, not the lowest end, set plate, right? Everyone gets the same, or once in a while they can, you can order this or this. We do, one of the things that we found is we do feed them and speak. So I think people appreciate it. I've done both, where you feed them first and then you talk, or you talk and then you feed them.
So you'll speak while they're getting fed. So the time's more expeditious. You have to deal with the occasional clinking of knives.
That's exactly. And we just tell them we're going to speak, while we present, so that we can get you out of here before 11 o'clock tonight, as a joke. And, if you could just kind of keep it to a minimum, table talk. And people really appreciate it. I used to do it where we did it, different ways, but now it just got too long, right? Okay. People are looking at their watch. And so, we've done it and it's worked well. It hasn't really affected the results at all. So we're going to continue to do it that way.
So how long is the session then? How long?
Usually session's hour and a half. We try to do, the seminar, maybe hour and 40. I mean, not counting check-in. So, but the actual presentation, hour 20 is about where I run. So it's not 45 minutes, but it's not 2 hours.
Okay.
And we've just gotten a lot of really good feedback. People seem to be engaged. And like I said, the numbers work.
And then do you do follow-ups to get them to sign up, or are you like schedule a meeting on site while we're right here?
We do the on-site. So we start off with schedule a meeting now. There's usually a giveaway, a book or something of that nature that we give away, and have a calendar, have a staff person there, a team member. They sign them up, and then for those that don't, we do a follow-up. So we will follow up with them, and we call it the 3-strike rule. So we'll follow up with them, email them, follow up. We'll reach out 3 times. If there's no response, then we're going to put them on a drip. So we're not going to hound them forever, but we want to give them the opportunity. And like any marketing, we get a couple a year that say, I came to your seminar 2 years ago and, it wasn't good timing, but now I'm ready. Right. I want to meet. Right. So it's, activity breeds to more activity. So we see that as well. And now that we've been doing it for the last few years on a consistent basis after COVID, we're seeing some more of that as well.
And then who's your provider to do the campaign that's actually like getting successful turnout results for you?
Yeah, we use a couple different groups. Leading Response is one. Lead Jig, we can put it in the show notes as well and share those. We've worked with a couple different groups to mix up the list, the way they search.
So why, like, how do you decide which provider you're using, or why multiple providers?
Well, the decisions come in a couple things. One is that results, and so we got to be careful on crossing. If we're doing a campaign in an area, we want to keep that same provider throughout the campaign in the spring or whenever we're doing it. So that's a factor. I also, we've mixed up, I still don't quite understand how exactly they get to the names. They say they take this out and that out. And sometimes, get someone that has a, investment profile of 3 million plus, and then they come in and they don't have $1. Okay,
Yep.
how'd that work? And I know it's not perfect. So we've just mixed it up. We've had success with both of them. Okay. The thing is that I think it's got to have a good message. They take care of all the sign up, right? All we do is show up. We do have a process of confirming. We make sure we confirm them, but again, we have fall off, and it's about mailing enough. So, and how much do you have, and about mailing enough in the area that you're doing it to get the people there.
And so how many mailers do you have to send on a campaign to get a good turnout?
Yeah, usually if we're doing 2 nights, you're talking 8,000 mailers, and any of these companies can boost with Facebook if you need to. Although we have found that to work subpar, because again, then it opens it up. It's a little harder to kind of, target invite. Okay. If we're going to go 3 nights, then typically we go 12,000 mailers. Okay. And we really leave it to, here's how many we want in the seats, and you tell us what we need to mail. And then we also stress that, we don't want to minimize mail, because we kind of look at it and say, if we're going to be there anyway, whether we have 12 or 20, we're there. Right. Our time's there.
So we may as well fill the room.
Right. Yeah. We're not going to just pinch the penny, right? We might as well fill the room with hopefully targeted good candidates. And that's how we go about it.
And as I take it, you're in a city or metropolitan area that has enough density that like there are 12,000 people to send to get your turnout, your desired turnout numbers?
Yeah, that's a great question. It depends on our area, because we are in different areas. Some areas we can't get to the area as much, right? And we can't get as high an IPA.
you're Indiana and Detroit
and
and
Florida.
somewhere in
Yep.
Florida.
Yep.
Okay.
So Detroit, Florida, much more, a lot more to mail to, just based on the demographics.
Right.
And so we don't have a problem getting to our demographics there. The other areas, you don't want to overmail. We have to, be conscious of that. We typically don't do as many seminars there. So we just go based on the area.
And then what does it end up costing you to do just a whole cycle, like the campaign mailers, the restaurant food, like what's the cost of a marketing cycle for you?
Yeah, you're going to be, it's anywhere between, it's about 10,000 to 12,000 all
Okay.
in, depending on the number of nights and so forth. All of our marketing campaigns, we're running under $3,000 per new client right now, which is awesome. So,
And
so
your average client, as you said earlier, like is 700,000, and new ones are over 1 million. So I mean,
that's right.
you're 2 to 3xing your marketing spend in new client first year revenue.
That's correct. Yeah, we're going to
Okay.
push this year about 35 million just from seminars. So I look at it, and the seminars that we did in that time frame, if there's 100,000 spent in seminars, 33 million, 1%, right? You can do the math. And I look at kind of a break even at that 2-year mark, which we're there, right? Long-term client, right? Ongoing revenue.
Yeah.
So, the math for us, fortunately, has worked out.
So anything else you're focused on from the marketing end, or like this is the driver, this is what you do, it's working?
No, we do have multiple things we're working on. We have worked on increasing our SEO and increasing our Google reviews, and trying to be more present in the SEO world. People finding us, find an advisor near us. We've really increased our Google reviews, and we had a campaign that we've been just asking clients, right, in certain ways, hey, will you leave us a review? And we refreshed our website, and now we're working on more of a digital presence. We want more people to come to us. We get some of that, but we want more people to come to us.
So what's your process for asking clients for Google reviews? I know some advisory firms have been nervous about how to do that and make sure they stay compliant.
Yeah. So what
What's
we
your
did,
process?
so what we did is, first off, we, from a compliant perspective, certainly want to make sure that it's compliant, and that, we're asking everybody. We can't narrow people out. So we have really 2 reviews. We have a Google review, and then we use a company called Amplify. Amplify is an internal review system, star system, and so forth, because we, a lot of people don't have Gmail, so we wanted to build the reviews and be able to have it on our website. And so what we built was a process of, when a client came in for a service review, after the meeting, it was automatic, an automation that was built, that an email would go out to the client and say, thanks a lot for meeting. If we'd love to have you leave us a review. That simple. But it was automated because the advisors would forget.
Right.
I got to ask them,
Or
oh, shoot, I had other stuff.
or worse, you forget, except you don't forget for your best clients,
Yeah,
and now you're doing the cherry picking thing that the regulators don't like.
exactly.
Accidentally, but you can still end up there.
Exactly. And then you might say, well, okay, how do you get beyond that? Because what if someone doesn't have an email or a Gmail? So the automation says, if they don't have an email, and we still have a few of those, there's an automatic to do that goes to a team member, and they send a postcard. So it was interesting how to get by this, because they don't have an email. So how are they going to leave a review? But by documenting within our CRM system, we send them a postcard. We really love a review. So we don't leave anybody out.
Okay. So it's not
So
necessarily because you're literally trying to get postcard reviews so you can like take a snapshot of the postcard and post it to your website. This is compliance documentation, validation of, no, we're trying to really systematically ask everyone, so we're doing it fairly and we're not being selective. Heck, even the people who don't have an email, there's a system to make sure they're getting asked as well with the postcard.
That's correct. That's correct. And the system is built so they come in again. If they were already asked and they opened it, they're not going to get another one. So we're not going to bother them, like you didn't do it last time. If they didn't open it, then we'll send them another. And so we did
Okay.
that this year to boost our reviews, and really try to boost the SEO part of it.
Because I was going to ask, do you then get the problem where um, clients have already done a review and you're still systematically asking them, and now they're like, why do you keep asking me? I already did
Yeah,
this.
it's a great question. The answer is no, because in the background, it's automated. So if they leave a review, we use Active Campaign. Our marketing leader,
Yeah.
she runs Active Campaign. It automatically knows that the review was left. Don't send them another one. How they connect it, I don't know. But there's those. So I
Okay.
absolutely was adamant about exactly what you said, Michael.
Okay.
I don't want people being
Yeah.
bugged. I just left you a
After they did.
review. Yeah.
Yeah. So you built it into the marketing campaign.
Build it
Okay.
into the campaign active campaign that it knows if it left a review or not, an if then, and
Okay.
so it
Yeah. Yeah.
doesn't continue to bother people from a review. We also make sure a couple things. We respond, so we have a team member responds. Thanks a lot for the reviews. So we went from 4 or 5 to we're well into the hundreds, and I think we're at 120 or something for
Oh
all sites,
wow.
which, for a financial firm, I think is pretty good. We actually have several hundred when you add in the Amplify reviews.
Oh,
So,
interesting.
yep. So we've had a lot of people leave on
Be,
Amplify for
be,
multiple reasons.
because yeah. So why are they leaving on Amplify instead of leaving leaving the Google review?
A lot of them, they didn't have Google. So,
Okay, so they don't have a Gmail account to leave a
right.
review.
Right. The other thing we did is we originally started with Amplify just because it was a little bit more controlled. We could kind of get,
Yeah.
how we were going to do it. And we wanted to have these reviews, on the site. And then we're like, okay, the next level is the Google review. And so they really have a choice.
Okay.
And so,
So
yeah, it's worked
because
really well.
Amplify gives you something you can put on your site, but Google reviews are happy in the Google ecosystem for all the people who Google search. If you want to do well on Google, you actually need the Google reviews.
That's correct. So I think, making sure it's compliant, but having those systems in place. And then when they do post a Google review, we respond. Thank you so much. Appreciate it. Um, and so that's another, the whole digital area, I think is an area we want to work on. And I've seen a lot of statistics that a lot of new clients are finding advisors digitally. So,
Well, I'm fascinated with just this idea of running it as a two-pronged approach, because if you're as great as Google reviews can be because of all the Google SEO benefits, if the clients don't have a Google account, they can't do it. So if you give them a second pathway like Amplify, you get some way to capture the review that they were willing to leave. So what do you do with the Amplify reviews? I mean, the Google ones are on Google, so anybody who Googles you is going to see them and click through. What happens to the Amplify reviews?
they run on our website. So they run
Okay.
on our website, they pop up, and then they also run by advisor on their bio page for their clients that's commented.
Oh, so just like Amplify has website integration-y things
Yeah,
that they do so that they can make the reviews appear for particular advisors on their individual advisor page.
correct. Yep.
Oh, that's
So
pretty
we do
cool.
that. We'll do it. We'll throw up some reviews, on a presentation. Hey, here's some of our reviews, right? Google or not, we've gotten these reviews. We've got X number of views. So we use it for that piece. And it's all about when people land on the site, right? It's verification. We're
Yeah.
going to now work on, testimonial, even the next level, right, of a client, thumbs up, and how we're going to do that process. But it's all focused around this SEO and building our SEO.
And because I know this is just a fear for a lot of us, like, do you ever get a bad review?
No,
How do you handle a not good review that shows up?
knock on wood, we have not.
It just hasn't
Um,
happened. You got
and
100 plus, and it turns out happy people reply.
yeah, yeah. I mean, it does, and I'm sure that's going to happen. And we actually have a process. As I said, we answer all Google, all reviews, all Google reviews. So we have a process on, how to still respond. One of the things I learned from just setting up the process and was advised on, you got to respond to all of them. You can't ignore if it's one that's not, positive. But I just felt like it was going to be something that we need to do. Everyone shops by reviews,
Well,
right?
well, I mean, at the point you have 100 good reviews, it reminds me. I forget where it was from, the study that came out a bunch of years ago that actually found that consumers were more likely to buy from something that was rated like 4.8 or 4.9 stars than they actually were to buy from something with 5 stars. Because with all 5 stars, you got to wonder a little bit if it's padded. If it's 4.8, it's like, oh, okay, they got to be pretty good. And someone's always cranky,
Exactly.
like weirdly
Exactly.
more trustworthy. So now I'm curious, as you reflect back on just this journey of building the firm, of going deeper with all the tax solutions tied to the firm, what's what surprised you the most of this pathway of going deeper on tax planning and tax preparation in this business that you were running for 20 something years before you ever added tax?
Yeah, I think what really surprised me the most was I thought financial that it was pretty similar, and it's really in multiple facets a different business. Um, I didn't think it was going to be exactly the same, but we've had to make some adjustments along the way and thoughts along the way in that business.
So
Um,
what's so different?
Well, a couple things. One is client, the tax return clients. So those that book of clients, and we shared with you about the acquisitions. There's a book of return clients that you get some that don't come back, and you get a group that shows up. That's different. Um,
Oh,
Part
so
of
there's
it.
just like a capacity planning thing. I don't have to I mean, I have to plan for maximum capacity, but I don't have to wonder next year, like, are 50, 70, or 80% of my clients coming back? It's just like, are all of them or all of them but one
Right. Right.
coming back?
Yeah. Exactly. Planning for the just crazy rush,
Yeah.
the time frame, and coming in and doing from data entry to check to sign off of the return, is a different process. um Really allowing to dig more into actually the tax return. I mean, a lot of us, I think, wealth clients we had, or wealth advisors, we had pretty good understanding of it, but that surprised, like some of the things we've learned under the hood. That was a bit of surprising. That also has also been helpful. And really the response. I'm pleased with the response of the client. We I did some talking with, and top clients were thinking about doing this. What do you think? Um, and We're really pleased with the overall response. And one of the things that we all the time think about is, if something happens on the tax side with a client, and they're just a tax client, you might lose a six, seven, $800 whatever, return, right? And they leave you.
Yeah.
But if it happens with a wealth client and you're managing $2, $3, $4 million, that's a lot of revenue that goes out the door over something on the tax side. So, um, so that, you know,
Well, that's kind of
that's,
scary, daunting in the other direction then.
it is. And, you just have to manage, just have to work for that. One of the things we do is any of the wealth clients of Elite and our top clients, once the tax return's done, it goes to the wealth advisor, and they review it. So they're not looking for the tax side, but they know the client situation throughout the year. And so they take a look at it, and we promote that to clients. And what we say is, it's going to get done, and we're going to do a review for you, right? Me as your advisor, I'm going to take a look as well, another set of eyes. And that's been a really nice ad that people know. Um, so trying to tie that in. But I really didn't think about that getting into it, going, yeah, well, if a wealth client's not happy because of something helping tax wise, And I knew people freaked out about taxes, but having the tax business now, $200 difference, people can flip out about taxes.
$200 difference in the taxes they owe or in the cost of the
Yeah,
return?
just on, I remember one case we had a client, they did $11,000 Roth conversion and they agreed to it. And, they got their taxes back and their taxes was different than what they thought. And they just were not happy, but they had forgot they did the $11,000 Roth conversion. And it really only changed the tax by, a handful of hundreds, 300-400. It wasn't a tremendous amount. You would have thought it was, 20,000. And luckily it was resolved, but it really, when we were doing just the planning side and sending it off, we didn't hear it. It really, now we hear it all. And it was surprising to me that, just a small amount of change can really, people can have bad feedback.
So what was the low point on this journey for you of building the
Yeah,
advisory business over the years?
I mean, my low point would be, when I started in the business and I grew up in an entrepreneur family, and then we sold the business and I got into this and I'm like, I can do this. And I got in and, after my first year, I mean, I just about failed out. So, I was with the broker dealer, just about failed out, and they let me stay. And, young family and all of that, really questioning, like, should I be doing something different?
Yeah.
And I stuck with it, and and it's well worth it. But that was certainly a challenging time. New marriage, new family, all of that, and wondering if this maybe is not for me.
So what pulled you through?
Perseverance and working hard, and uh, if someone said no, I said next and said, you know what, I think I can do this, or I said, I know I can do this. And it pulled me through. And certainly having um, you know, the goal of providing for my family. When I got into the business, I told the person that was hiring me, I just, I want to have my wife be able to stay home and, be with our kids as they grow up. And I don't want to live on ramen noodles. So I'm going to do, what it takes. And so that really carrot out there made me do things that, were tough at times. But it was worth it.
And when did you know it was gonna work? Like, was there a moment of I think I've made it. I'm actually gonna stick with this. It's gonna turn out okay.
Yeah, I did. It was probably almost 3 years, 2.5 years to 3 years in, 2.5 years really going, okay, now I've got this. There was some momentum. The work was paying off. Still absolutely hard work. But I just saw so many people fail and have seen so many people fail. And I just knew there was something better. And I'm glad I stuck with it.
So what else do you know now you wish you could go back and tell you 10, 20 years ago about this path of building a multi-million revenue advisory firm?
I wish, Michael, I would have known to develop my leadership skills more. I grew up and I was trained, I think, well as an advisor and as a financial planner, and I did that from day one, really, and did planning. But who knew that? Oh, we got to run people, and
Right.
and a lot of leaders, right, that are in large corporations, they get mentored and schooled for years, right?
Yep.
And yes, I did some leadership training and so forth, but really didn't take it like, oh, I'm running a team now. And it's a different skill set. So I really wish I would have wrapped my arms around more of development from a leader perspective. On the other hand, I look at it and go, well, I don't know if at that time if I would have been able to split enough time off to
Yeah,
actually do
yeah.
more development, but I think I would have figured it out and put a little more emphasis on my leadership and building a team and my leadership development that I think would have been certainly helpful along this journey.
So how did you ultimately solve for this? Was it all School of Hard Knocks, or did you find training or resources or other solutions later in your career to fill in for this?
Well, it's kind of both. So, I've kind of lived and learned along the way. I mean, I certainly, as I said, grew up in an entrepreneur family. My dad was, my biggest mentor and all of that. So I had some of that, but I was young. I've also hired coaches along the way. We have a coach now that we work with. So it's a matter of getting professional coaching, right? That I can bounce ideas off of. It's also helped to be involved in a couple focus groups, of other firm owners, bounce ideas off of, reading, development, listen to podcasts. Podcasts overall have been a big help, picking pieces out from different podcasts. So I felt like I've made up a lot of ground, but I feel like if I would have known that or saw that coming, I could have been a bit more prepared.
So, can I ask what coach or coaching organization you work with that you're having good experiences with?
Yeah. So we, the firm's Lennox Aberman, and Ray
Okay.
Kelly's the coach that I work with, and he's doing a great job of just helping us develop, as a leader and developing other leaders within the organization. So we feel like we're not going to be able to raise it up. We need to develop other leaders within the organization. And so that's, one of my focuses going into the next year.
And then any particular books or podcasts that have clicked for you?
A lot of them. Your podcast has been great. I listen to, a lot of different podcasts. I really don't have what I would call, one that just absolutely sticks out. I kind of bounce around a bit. I've read Good to Be Great and those kinds of books as well. Getting the right people on the bus. So that's a big piece of it. So I've just tried to put it together. But again, I don't feel like I've been schooled in it.
Yeah.
And some of it was kind of the school of hard knocks and learning along the way, make a mistake and get up and, figure it out
Yeah.
going forward. It's been a good journey though.
So what advice would you give younger, newer advisors coming into the profession today?
Yeah. I mean, the advice I would give is that this business is complex. You need to find a place where you feel like it's a fit for you, and you need to just take it all in, and you're in your residency, so you don't become a doctor overnight or just because you have an education. So you need to take it all in, and learn not only the advice side, dealing with clients. It's so complex now, which we talked about, planning, tax, and then really find where you really will thrive. What area will you thrive in? But give it some time. Give it some time really to really get to understand the business and find where you'll thrive.
And when you say give it some time, like what kind of time are we talking about?
Yeah, in the business, I think anyone between 2, 3 years, 4 years, can get a really good sense of the
Okay.
business and what a fit is. And I think most people have a good sense. They certainly could change a little direction, but they'll have a good
Yeah.
sense of it, I believe.
So as we come to the end here, this is a podcast about success, and just one of the things we've long observed, that word success means very different things to different people. And so you're on this wonderful path of building the business successfully as you're crossing 5 million of revenue and 600 million of assets. And so the business seems to be in a wonderful place now. How do you define success for yourself personally at this point?
Yeah, what I define success as just wanting to have my team be successful, whatever that means to them, which in turn the clients are successful. So I get really motivated when I hear of a client story and they've done this. They've helped pay off a house, of their kids, or they've helped, or they're taking this trip with the family. And in turn, I really like having the team develop and grow, and in turn have their success. Um, that just sums it up for me. That's what motivates me now, is wanting people to succeed that's in my tight world.
I love it. I love it. Thank you so much, Erik, for joining us on the Financial Advisor Success Podcast.
Michael, it's been a pleasure. Thanks for having me.
Thank you.
Want even more ideas, tools, and resources on how to break through to the next level of success as a financial advisor? Check out the leading financial planning industry blog, Nerd's Eye View, at www.kitsis.com, where Michael covers the latest practice management trends and financial planning strategies. And by joining the members section, you can earn IMCA and CFP continuing education credits, along with exclusive member content. Get it all now at www.kitsis.com.